Imagine two neighbors living in identical houses, driving similar cars, and buying the same groceries at the same supermarket. Let's call them David and Robert. Both men have exactly $100,000 landing in their bank accounts this year to cover their lifestyle. On the surface, their financial lives look indistinguishable. They have the same purchasing power, the same standard of living, and the same bills. But when April 15th rolls around, something drastic happens that separates them completely. David, who is 50 years old and works as a project manager, sits down to file his taxes and realizes that the government has already taken roughly 20 to 25% of his money before he even touched it. He likely owes a little more, or perhaps gets a small refund of his own money, but the total friction on his income is massive. He kept maybe 75 cents of every dollar he earned. Then there is Robert. Robert is 65, retired, and effectively unemployed. He also brought in $100,000 this year to pay for his life. But when Robert sits down to file his taxes, his effective tax rate isn't 20%, it isn't 15%. Depending on how he structured his accounts, it might be less than 5%. In some perfectly legal scenarios, his federal tax bill on that six-figure income could be zero. This discrepancy feels unfair to the worker. It feels like a glitch in the matrix. Why does the person setting the alarm clock, commuting in traffic, and trading their life energy for a paycheck pay a heavy toll, while the person playing golf and withdrawing funds from a brokerage account pays almost nothing? The answer isn't a conspiracy, though it can feel like one. The answer lies in the fundamental architecture of the United States tax code, which is designed to tax labor and capital as two entirely different species of money. To understand how to win the game of money, you have to understand that the IRS does not view all dollars as equal. They view dollars based on their origin story. And the journey to financial freedom is really just the process of moving your income from the labor bucket to the capital bucket. Just a quick note before we dive into the mechanics of this. I am an educator, not your personal financial advisor or accountant. The tax code is complex and changes often, and your specific situation has nuances that a video cannot address. This is for educational purposes to help you understand the system, not individual advice for your tax return. To understand why the retiree keeps so much more of their money, we first have to look at the heavy lifting required to earn a paycheck. When you work for a living, whether you are scrubbing floors or performing neurosurgery, you are trading time for money. The IRS classifies this as ordinary income. This is the highest taxed category of income in existence. It is the low-hanging fruit for the Treasury. When you look at a pay stub, you see the obvious deductions, but we rarely stop to think about the layers. First, you have the federal income tax. This is progressive. In 2024 and 2025, those brackets climb quickly. You start at 10%, jump to 12%, then 22%, 24%, and up. If you are single and earning $100,000, a significant portion of your income is being taxed at that 22% marginal rate. But the income tax is just the cover charge. The real friction comes from FICA, the Federal Insurance Contributions Act. This is the payroll tax that funds Social Security and Medicare. If you are a W-2 employee, you pay 7.65% of your gross income into this system, starting from the very first dollar you earn. There is no standard deduction for FICA. There are no write-offs. It is a flat tax on your survival. And here's the kicker that most people forget. Your employer matches that 7.65%. Now, you might think, well, the employer pays that, not me. But economists generally agree that the employer's share is actually money that would have otherwise been paid to you in higher wages. It is part of the cost of employing you. So in reality, the tax wedge on your labor is over 15% for FICA alone, plus the federal income tax, plus state income tax. When you add it all up, a worker earning $100,000 is essentially splitting their income with the system in a very aggressive way. The system is designed to take the money at the source, pay-as-you-go withholding, because if the government asked people to write a check for $25,000 at the end of the year, there would likely be a revolution. Now, let's pivot to the retiree, Robert. Robert has stopped trading time for money. He is no longer a laborer, he is an owner. He has crossed the chasm from relying on human capital to relying on financial capital. And the United States government loves owners. The first reason Robert's tax bill is lower is because he has escaped the orbit of FICA. Social Security and Medicare taxes apply to earned income, wages, and salaries. They do not apply to investment income, pension income, or withdrawals from 401ks and IRAs. The moment you retire, that 7.65% tax on your cash flow vanishes instantly. That alone is a massive raise. But the real magic happens in how the federal government taxes the money Robert pulls from his investments. Let's assume Robert has a brokerage account, a standard taxable investment account where he holds index funds or stocks. When he sells shares to generate cash for his spending, he triggers capital gains. The tax code treats capital gains with kid gloves compared to wages. Why? The theoretical argument is that investing involves risk. You could lose your money. To incentivize you to take that risk and provide capital to companies so they can hire the Davids of the world, the government offers a discount. There are 3 long-term capital gains tax brackets: 0%, 15%, and 20%. Yes, you heard that right, 0%.
For a married couple filing jointly in 2024, the 0% capital gains bracket goes all the way up to roughly $94,000 of taxable income. That means if a retired couple has no other income, they can realize over $90,000 in profit from their investments and pay exactly $0 in federal tax on it. If they are single, that number is roughly $47,000. But wait, it gets better. This brings us to a concept called basis, which is perhaps the most misunderstood aspect of retirement income. When David, the worker, earns $100,000, the IRS views almost the entire amount as taxable profit. He didn't buy his salary, he worked for it. It's all new money. But when Robert sells stock to generate $100,000 of cash, the IRS doesn't tax the whole amount. They only tax the growth. Let's use a simple metaphor. Imagine Robert bought a classic car years ago for $50,000. Today, he sells it for $100,000. He has $100,000 in his hand, but his gain is only $50,000. The first $50,000 is just his original money coming back to him. That is his basis. You are never taxed on the return of your principal, only the return on your principal. So apply this to Robert's stock portfolio. If he sells $100,000 worth of stock and half of that value is his original contribution and half is growth, his taxable income is only $50,000. If he is married, that $50,000 of taxable gain sits comfortably inside the 0% capital gains bracket we just talked about. Let's do the math on that. Cash flow, $100,000. Taxable income, $50,000. Tax rate, 0%. Federal tax bill, 0. Meanwhile, David, the worker, generated the same $100,000, but his taxable income was the full amount, and he was hit with income tax and FICA tax on every penny. This is the fundamental shift. Retirement income is often a mixture of return of principal, tax-free, and capital gains, preferential rates. Working income is all profit, taxed at ordinary rates. Now, critics or sharp listeners might be thinking, what about 401ks? What about traditional IRAs? And you are right to ask. If Robert has all his money in a traditional 401k or IRA, the rules are slightly different. When you pull money out of a pre-tax 401k, the IRS treats it as ordinary income, just like a paycheck. You don't pay FICA taxes on it, which is still a win, but you do pay your marginal tax rate. However, even here, the retiree has an advantage: control. David cannot control his income. His paycheck comes every 2 weeks, and the tax is withheld automatically. He cannot tell his boss, "Hey, don't pay me in December so I can stay in a lower tax bracket." Robert, however, is the CEO of his own life. He can engineer his income. This is where the strategy of tax diversification comes in. Most savvy retirees have 3 buckets of money: taxable, brokerage accounts; tax-deferred, traditional IRAs and 401ks; and tax-free, Roth IRAs. By mixing and matching withdrawals from these 3 buckets, Robert can dial in exactly how much taxable income he shows the IRS. He might pull $40,000 from his traditional IRA to fill up the standard deduction and the lowest tax brackets. Then he might pull another $40,000 from his brokerage account, which is mostly return of principal and low-tax capital gains. Finally, if he needs more cash for a vacation, he dips into his Roth IRA. Roth IRA withdrawals are the holy grail. They do not count as taxable income. They do not show up on the tax return at all. If Robert pulls $20,000 from a Roth, the IRS sees nothing. It is a ghost transaction. So let's look at the aggregate picture. Robert could have $100,000 in spending money composed of $30,000 from a traditional IRA, $40,000 from a brokerage account, and $30,000 from a Roth. His taxable income on paper might be less than $40,000. This keeps him in the lowest tax brackets and ensures he pays almost nothing while living a 6-figure lifestyle. There is, however, a complication we need to address, and it involves Social Security. This is the one place where the tax code can actually get a bit nasty for retirees if they're not careful. It's a concept often called the tax torpedo. The Social Security Administration has a unique formula for taxing your benefits. They look at your provisional income. This includes your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. If this number crosses certain thresholds, which are surprisingly low because they haven't been adjusted for inflation in decades, up to 85% of your Social Security check becomes taxable. This creates a weird phenomenon where earning $1 extra of income can trigger taxes on 85 cents of benefits, creating a very high marginal tax rate for a small window of income. But even with this torpedo, the overall effective tax rate for a retiree rarely approaches the burden carried by a full-time worker. Why? Because again, FICA is gone and the standard deduction for seniors is higher. The standard deduction is the amount of income you can earn before you pay a single dime of federal income tax. For a married couple, both over 65 in 2024, the standard deduction is over $32,000. That means the first $32,000 of ordinary income, like interest or IRA withdrawals, is free. David, the worker, gets a standard deduction too, but remember, he is paying that 7.65% FICA tax from $1. The retiree doesn't start paying until they cross that $32,000 threshold. So why does the system work this way? Is it fair?
Fair is a subjective word. The tax code is not designed to be fair. It is designed to be a collection of incentives. The government wants to encourage certain behaviors. They want you to work, hence the earned income credit for low earners, but they also desperately need you to save for your own future so you don't become a ward of the state in old age. To bribe you into locking your money away for 30 or 40 years, they have to offer a carrot. That carrot is the preferential tax treatment of retirement funds and capital gains. If capital gains were taxed at 40%, nobody would invest. They would just spend the money or hide it under a mattress, and the economy would grind to a halt because businesses wouldn't have access to capital to grow. Therefore, the system is rigged in favor of the saver. The system is rigged in favor of the investor. This leads us to the most important takeaway for you, sitting here today, whether you're 25 or 55. You cannot change the tax code. You cannot lobby Congress to abolish FICA tomorrow, but you can choose which game you want to play. Most people play the labor game their entire lives. They focus solely on increasing their salary. They want a raise, they want a bonus. While earning more money is great, every extra dollar of salary is taxed at your highest marginal rate. It is the most expensive money you will ever earn. The goal of financial independence is to start shifting your resources into the capital game. This means prioritizing the accounts that give you options later. For example, consider the Roth IRA and the Roth 401k. When you contribute to a Roth, you are choosing to pay the taxes now, while you are working, yes, and it hurts, but you are buying your freedom later. You are effectively paying the toll on the seed so you don't have to pay the toll on the harvest. If you have $1 million in a Roth IRA at age 65, that is a true $1 million. It is all yours. If you have $1 million in a traditional pre-tax 401k, the IRS owns about 20% of it. You are just holding it for them. This distinction is why the $100,000 number is an illusion. If David wants to spend $100,000, he actually needs to earn about $135,000 gross salary to cover the taxes. If Robert wants to spend $100,000 and he has a mix of Roth and brokerage assets, he might only need to withdraw $102,000 to have $100,000 in spending power. The efficiency of the retiree's income is vastly superior. There is also a psychological component to this. When you are working, your income is tied to your active effort. If you stop, the money stops. The government knows this, and they tax you as a captive audience. When you are retired, your money is mobile. You can move to a state with no income tax. You can control your realization of gains. You have leverage. So, how do you apply this to your life right now? First, recognize that gross income is a vanity metric. Net income is sanity, but after-tax spendable cash is reality. When you project your retirement needs, don't just use a generic calculator. Think about the sources of that money. If you are stuffing everything into a pre-tax 401k, you are setting yourself up for a retirement where you are still somewhat of a tax slave. You will have a required minimum distribution, or RMD, at age 73 or 75, where the government forces you to withdraw money and pay taxes on it whether you need it or not. But if you build a taxable brokerage account alongside your retirement accounts, you are building a basis bucket, a pool of money you can access with very low tax liability. If you prioritize the Roth, you are building a tax-free bucket. The ultimate financial strength is having all three buckets full. That gives you the power to manipulate your own tax bracket. In a year where you need to buy a new car or pay for a wedding, you pull from the Roth or the brokerage to keep your taxable income low. In a year where your spending is low, you pull from the traditional IRA to use up your standard deduction. This is called bracket management, and it is the secret weapon of the wealthy. They don't just earn money, they engineer the recognition of that money. Let's go back to David and Robert one last time. David views taxes as something that happens to him. He opens his paycheck, sees the money gone, sighs, and moves on. Robert views taxes as a variable expense that can be managed, minimized, and optimized. He understands that the code distinguishes between the sweat of your brow and the fruit of your capital. The transition from David to Robert is the journey of financial independence. It is the realization that the most efficient employee you will ever hire is your own money. Your money doesn't need sleep. It doesn't need health insurance. It doesn't pay FICA taxes. And when it earns a profit for you, the government asks for a much smaller cut than it asks from you. So, as you look at your finances this week, don't just ask, how can I earn more? Ask, how will this income be taxed when I receive it? Are you building a mountain of ordinary income for your future self, or are you building pools of capital gains, return of basis, and tax-free Roth distributions?
The dollar you earn from labor is heavy. It carries the weight of social safety nets and infrastructure on its back. The dollar you earn from capital is light. It is aerodynamic. It is designed to travel further. The game is to trade the heavy dollars for the light dollars as fast as you responsibly can. Because in the end, it's not just about how much you make, it's about how much you keep. And the person who understands the difference between W-2 income and retirement income gets to keep a whole lot more.